We're live. Mike Brown is here with us in the audience, who is our Director of Investor Relations. Courtney Moeller is with us from Iron Horse Energy. Okay, guys, ladies and gentlemen, welcome. I am so excited to share with you what we're doing with BuildEnergy II and the arrangement that we've made. Before we get started, I just want to share that there is a chat box, and there is also a little Q&A square in there as well. We're going to do what we can to answer some Q&A at the end, but if you can use the Q&A section rather than the chat section, it makes it easier for us to figure out, okay, what are the questions, and if we're able to get to answering them at the end, then we can mark them off as we're going through. So just a little pro tip. Mike Brown is our Director of Investor Relations. He's going to be dropping in the chat throughout the talk today, just his cell phone number and also the portal link so that you guys have it, okay? And with that, let's jump in. So here's what we're going to cover today, okay? Basically, we're just going to, right set and frame, what is it that we're doing at Build Wealth, and just kind of give a reminder about it. I know a lot of you guys have seen a lot of my deal drops. This isn't a big, long explanation. I just want to kind of remind everybody, where we are and what we're doing. Second, it's really important. You'll remember that I've shared with you guys that at times I even almost called Build Wealth, supply, demand, and balance, because it's that important. And it's very clear that all of the empirical evidence supports the fact that we are in a major opportunity of supply and demand imbalance in the oil and gas sector right now. And so we've covered a lot of this with the first energy fund that we did. And so again, I'm going to give a brief overview of that, and we've got all the recordings from last time if you want to drop down into that deeper. And lastly, we're going to go through the BuildEnergy II fund, okay, and go through all of its total awesomeness, okay? But if you know me, we're not going to wait. I'm going to give you a little teaser before we get into the whole thing. First, I have to start with a disclaimer. This is ultimately I can't give financial advice. Be an adult. Life is risk. You might lose all your investment. This is not a pitch of securities. This is for entertainment purposes only. But of course, there is a PPM and all of that. And I'm investing in this as I do all of our funds. And so you can jump in and join me if you want to be an adult and understand that there's all kinds of risks involved. Now, listen. With Build Wealth, what we've been doing is offering a lot of different private market investments to our community, okay? And the thing is at the beginning of the year, I came up with this goal. My goal was, by the end of this year, I want to offer a depreciation sink for people who ultimately are high W-2 earners, which are our investors, okay, and who basically are looking for ways to write off active income, all right? So it's one of these where we're focused on appreciation, we're focused on cash flow, right, and we're focused on, the supply and demand imbalances that, we can capitalize on in the private markets. But private markets also offer these other things, which is what are the little games that the rich people do to not pay taxes? And I want to share with you that there was 3 years in a row, in the late teens there, where my taxes that I was paying was actually higher than the earned income that I was bringing in, and it was an absolute problem. Okay, and one of the things that I figured out is that the current tax code is actually, well, just the IRS tax code is 6,700 pages. But once you start including all the examples and guidance and regs and all the rest of it, it's actually over 70,000 pages. 70,000 pages is the tax code. Now, here's the deal. The first page tells you what your taxes is that you should pay. The next 6,700 pages tell you how not to pay what's on the first page. Okay, and what the government has done, what the IRS has done, is build incentives for entrepreneurs and builders and people that provide jobs and infrastructure and resources to our country. And they give them the benefit of a big thank you, which is thank you for doing this for us. We are going to help you cut your taxes. Now, obviously, all of you know that we do a lot of real estate. And real estate has a lot of advantages, and there's a lot of ways to, depreciate, write-offs and all the rest of it on equipment. But when you really start drilling into it, pun intended, you start to realize that oil and gas, okay, has the best supported tax advantages of any investment out there, according to the IRS and what it is that they're willing to do. I'll let you figure out why that is, but ultimately it's because we need energy. We need energy in this country. And as we'll dig into some of the numbers, like green is great, but like it just can't come online fast enough, especially once you start adding all of the data centers and everything else. Again, we're going to hold off on introducing Courtney, but I'm going to tell you that her mission in life, okay, her mission in her career is to save $1 billion in tax savings for her investors. Okay. And that's what we are going to do. And so her new fund that she just launched is called Iron Horse Energy Fund One. And Build Energy 2 is the SPV that we've created in order to invest in it. Now, I want to highlight a couple of things. Why don't you just run out and invest in Iron Horse Energy Fund One? Let's just address this right up front. Number one, it's a $100 million fund and it has a $1 million minimum investment. Okay, so we've created Build Energy 2 so that all of us can invest together. Now, I've known Courtney a long time. We've worked alongside each other. She's taught me a lot about oil and gas. And the thing is that like I'm not going to go so far as to say that I've been a tough negotiator. What I'm going to say is that our relationship has gotten us to the place where we actually have reduced fees so that even if you had $1 million and went straight to Iron Horse Energy Fund One and invested in it, our structure here is going to be actually better. Okay. So what is Build Energy 2 and what does it look like? Okay. Here's what we got. It's not a $1 million minimum investment. It is a $50,000 minimum investment. Now, units are $25,000 each. So additional units will be at $25,000 increments. Okay. It's an 80 to 90% tax write-off. Okay. And what that means is this is active income. All right. That you have earned in 2025. Okay. It can also work for capital gains and passive income and anything else. But ultimately, the point here is that all of that income all of whatever your total investment is into the fund, 80 to 90% of that amount is a total write-off on your tax bill. Okay. But that's not all. It's not just like, hey, let's save on taxes, right? Like, let's make money with those dollars that we're not giving Uncle Sam. And so ultimately, with your total investment, our target is to get you between a 1.7 and a 3x multiple returned back to you. Okay. And so that's the goal. You're not only not paying taxes, you're also making money on the money that you're not paying taxes on. You're multiplying it, in fact. And so return of capital is going to be between 2 and 4 years back to you. And the total timeline for this fund is going to be between 5 and 10 years. Okay. So actually it's really front loaded. So you get a lot of big checks paid monthly right away. And then as time goes on and the wells start to deplete, they get smaller and smaller, but checks just keep coming as long as we continue to own those wells. And so, and then you've got a 20 to 32% projected internal rate of return. Walker, that's a really big range. Why is it so big? It's because it just depends if you want to count the tax write-off as that money that you're getting as part of the gain or not. Okay, the investment on its own in a base case scenario, it hits about a 22% internal rate of return and about a 32% internal rate of return once you count those dollars that you didn't pay Uncle Sam. And the importance of that is when you don't pay Uncle Sam that, whatever, $35,000 that you were going to on that $100,000 investment, what do you get to do with it? You get to go put that in a different investment, go throw it in our credit fund or put it back in Build Energy 2 and multiply it again, whatever it is you want to do with it. So that is real money that you get to save. Okay. Walker, let's back up. What is Build Wealth? What are we doing? Just remind me again, scope this out. Right. Here's the point. Look, we've all made it in life. We've become little rich. Okay. We have between 1 and, say $5 million. And, we're millionaires and now, we're accredited investors. And so we have access to the private markets and alternatives. But the truth is there's a new gap, okay, that we have to cross. And this is what I call going from the 2 to 20. This is like getting that first $1 million. We all know how hard that is. It is so hard. But once you get there, okay, there's another gap that you have to cross. Let me just break it down for you real quick. We've all seen this, okay? there's about 8% of U.S. citizens that have $1 million or more. Okay, and you can see the more in net worth you have, the lower these percentages get. But the thing is it's not until up here, like $30 million, that the financial firms consider ultra high net worth. These are the people that always had access to the things that we're talking about today and the things that we've been investing in over the last couple of years. And ultimately, this is where you actually have real safety, right? When you've got, say $2 million in net worth, you're, I don't know, a lawsuit, you're, a black swan event, I've lost everything in the stock market, half in the stock market, 2 or 3 times over. And it's terrible because you spend all of your time in exchange for money and you put it in the stock market and then overnight it like evaporates value, right? And so I've started allocating into my own businesses that I buy, as you know, and also real assets like the one we're talking about today. The goal is to build this permanence in what it is that we do. And we are down here, okay? And so here's the point that I want to highlight though. Check this out. If you get to 20 million, okay, you can go to sleep and hit 30 million. The only reason it's 80% success and not 100% success is because some of those people died, or they stayed super non-conservative, or most of the people that cross that, they have one single business and they sell it and then whatever. But the point is it's really easy to go from 20 to 30. What we're trying to do is go from 2 to 20. That's the gap, okay? And it's a hard gap to fill if you're not deliberate, okay? You cannot do that in the stock market unless you're a vampire and you live forever, okay? It's just too slow. So the point is that if you want your money to work as hard as you do, which is what I want, then you can't invest like the average millionaire. We need to start moving into things that have higher appreciation, higher cash flow, and all the rest of the things. And so what we do here at Build Wealth is we come up with family office deals for everyday accredited investors. Now, what does that mean? Well, when you start to look at, people with 50 million in net worth or so, look at how they're investing. Okay, just look at how they're investing. You've got, this is Tiger 21. This is their asset allocation. Just a reminder, guys. I mean, 54% is just in, real estate and private equity. Okay, and we're sort of, down in the lower left, the public equity section, all by our lonesome. And then, of course, there's private credit and real assets such as oil and gas. David Swensen created the Yale endowment model, I don't remember how many tens of billions over his 30-year career there, with a 13.7% average annual return over like a 38-year period. And what did he do? He was the one that realized that, everyone was sort of like overvaluing liquidity, because after a certain level, you don't need more liquidity. And so by tying things up into illiquid assets, you were able to get an extra premium in the same way that entrepreneurs do, in the same way that real estate investors do. And so by tying things up and allowing yourself to have some illiquidity, is the way that he was able to get outsized returns. So the way that we do it at Build Wealth is through the wealth stack format. Okay, this is how we allocate. We look for credit funds, we look for real estate, we look for private equity, we look for oil and gas. Every single one of our assets, okay, is something that I'm investing in. We're talking to Courtney today. I've invested in her last fund. I think it just started paying out, and I think I'm over 5% cash on cash returns already, which is amazing. And my former VP of Goldman Sachs, we did not bring into this particular fund. And I'll talk a little bit later about how we addressed diligence on Courtney and all the rest of it. But all of these things are things I'm investing in. I do GP level diligence on all of these investments. Okay, and what we're ultimately trying to do is just find things with outsized returns. And so our average deal, and BuildEnergy II is not on here, but our average deal is hanging out somewhere right around 30% projected returns. Okay, look, if this is your first call, I'd be surprised, but my name's Walker Deibel. I have been on every single side of a transaction. I've bought companies, I've started companies, I've been an M&A advisor on over 100 deals. I've sold my own companies, and all kinds of other stuff like that. I also wrote the single best-selling book in the world on acquiring small businesses. It's been adopted by multiple universities, and people kind of like it. The thing is with Build Wealth, okay, here's where we are now. We've launched 7 funds, 8 today. Okay, it's been around for 16 months, and you'll see with Courtney and everybody else that we've partnered with has been around for a very long time and has a huge amount of assets under management. We have over 200 investors right now, just in the last 16 months, which I'm super excited about. We've raised over $30 million in those 16 months. Thank you. I'm, by the way, the single largest investor in the entire Build Wealth portfolio, and I'm one of the top, I'd say probably 3 investors in every single fund that we have. That's probably true. And we've got a 33% repeat investment rate, which thank you so much. I just love that stat more than anything. I just value your trust and our partnership, and investing together is getting us bigger and better deals. Here's a heat map of where we're located, okay? And so really just the impact that we've had over the last year and a half is that we've actually become one of the largest independent capital raisers in the United States. So thank you so much for that. Now, Walker, what are we talking about today? Oil and gas? Isn't oil like cheap or whatever? Like what's happening? It's like trending down. Look, guys, first and foremost, again, I've talked about this on BuildEnergy II. We did a deal drop. It's on YouTube. I mean, we talk about this a lot, but here's the point. Okay, the point is that we are still extremely dependent on oil and gas. Okay, all of the investment in green energy and renewables has made an impact. But again, when you go look at my last deal drop, I talk about how hard it is. It takes decades to transfer infrastructure, okay, of energy. It takes decades, okay? And so, yes, I have, a Tesla, but I'm still plugged into the power plant. That's how I charge my car. Like and so, all of those airplanes, everything out there, it's almost all of fuel. 83% is, oil and gas. If you look at that same chart a slightly different way, it looks like this, okay? This is oil and this is gas in the top. This is where it's coming from, boys and girls. Okay, and the energy demand is expected to increase by 80%, okay, between now and 2050. All right, so an absolute huge ongoing demand and strain on capacity. Okay, and so by 2050, oil and gas will still make up over 50% of the world's energy mix. Okay, because our demand is outpacing our ability to increase renewables, okay? Now, here's the thing. Oil and gas deplete over time. So you have to keep drilling. You have to keep producing every single year, or else you end up with a supply glut, okay? And guess what? The dollars that have been going into oil and gas over the last few years is actually down like 82%. From the 5 years from 2013 to 17 to 2018 to 23, it's down like 82%. Okay, it's just like all of the private equity funding absolutely stopped. And actually, we don't show a 2024 and 2025 bar here, but you'll start to see everyone is seeing what we're seeing, and all of the money is being deployed back into private equity, but it's happening very, very quietly because the discounts are substantial at the moment. Remember that buy low, sell high thing? This is what the buy low looks like. It's when your friends are going, oil and gas, isn't that going down? This is when you buy low. This is what it looks like, guys, just to remind you. So we've got, here's what's interesting. You can actually peg barrels of oil to global GDP growth, okay? And it's really interesting because like the way that the way that this is relevant is that you can actually see that, GDP growth compared to oil, okay, run as a regression, is not only highly correlated, but we're becoming more and more efficient. We're becoming very efficient. So we can make more money with less oil. But this becomes very easy to predict how much oil and gas we're going to need in order to continue to produce any kind of GDP in the economy, okay? It becomes very easily predictable. And when you start to track this out, you'll see that, the biggest firms in the world are ultimately projecting 7.1 million barrels per day shortage by 2023. That is starting in 2 months, 4 years, okay? Call it 5 years. 5 years away, okay? So the thing is like, yes, oil is now trading at $63 a barrel. On the average over the last 10 years is $72 a barrel. And Courtney and I both believe that we are definitely going to be seeing, remember that disclaimer section. I'm not allowed to talk. I believe that, all the empirical evidence suggests that we will be back to $100 oil between now and 2030 without a doubt. Okay. Maybe that's why people, are going back into oil and gas in a really big way. This headline came out just over a month ago. It was like 34 days ago. Warren Buffett's jumping back in. So you start to look at, where all the big players are going, and they're going right back into oil and gas. Warren Buffett, Abu Dhabi, okay, I'm sorry, Abu Dhabi National Oil Company. Blackstone is coming back in. KKR, Apollo, Canadian pension funds, and sovereign wealth all coming back into oil and gas because everyone's realizing how cheap it is. Okay, so what we have is the short-term supply demand of literally today and tomorrow, sort of impacting oil and gas prices today. But the midterm is all the empirical evidence suggests that there's no way that we can actually rebound and fill the supply demand imbalance, which is why I'm so excited about everything that we are doing today. Okay, so listen, Courtney, but would you mind, just from a high level, would you explain what it is that we're doing here? Like, what is this fund doing?
Absolutely. And you did such a great job of even talking about what's going on in the market and why it's really important to kind of zoom out and look at the bigger picture and look at what the smart money is doing and look at not just what production and oil prices are today, but where they're headed. And I think that's where a lot of people have a hard time kind of drilling down and I guess maybe zooming out and looking at that overall picture. But this fund, and I've been involved in oil and gas my whole life. And part of what I wanted to do was be able to bring oil and gas, institutional level oil and gas investments to the everyday investor because being able to participate with people like Continental Resources and ConocoPhillips is just not accessible. These are multi-billion dollar companies. They don't need public money to fund their projects. And so we wanted to bring a product to the table that had really great diversification built in, not just by well, which we want a ton of wells, but by operator and by basin and even within those basins. And so these major operators have very, very low break-even prices, which is what keeps us, paying out distributions right now when we've seen even, as low as $52 oil this year. And a lot of companies were having capital calls and they were having to go offline. Not only were our companies going in and buying up those operators, but we were still doing distributions. And I think
Mm-hmm.
that's really important. So that break even is important. The diversification is important. And this is something, I've been building since April and I'm very proud of it. I'm very excited. And it's really about risk mitigation and diversification for our investors.
Awesome. Thank you. Um, what's the fund strategy?
Yeah, so I mean, we're gonna go in and acquire. We've been actually buying stuff up all year long because the great thing about the lower oil prices, it is really driven down acquisition costs, and so a lot of these smaller operators have had to go offline, and because we're getting these cheaper acquisition prices, it's giving us higher numbers on our tax benefits in year one, which is amazing, and so. We want to acquire a minimum of 50 different wells into this deal. I think we're going to be able to break that 100, but we want a minimum of 50. So, and like I said
Mhm.
before, we are going to target the top producing basins in the United States, which are really right along central US area. We've got the Bakken up in North Dakota, the Niobrara in Wyoming, Anadarko in Oklahoma, the Permian Basin, Eagle Ford. We are only going to go into these proven areas that have a 90+% success rate with these major operators. I know that if XTO or ConocoPhillips is going to spend $100 million to go drill a handful of wells, they started working on this project, probably a decade ago, and they have got the top of the line geologist and technology and equipment and everything to make this happen. And so it's a really great place to place a bet. I know they've done their homework and they're really good at what they do.
Mm-hmm. And how are we? Oh, sorry. I maybe deleted. Yeah. How does the team secure access to these programs?
And this is a really great question. And this I think what I'm
I mean, what does
probably
Conoco want with us?
they don't. And this is this
Right.
is just it. They don't need us. These are multi-billion dollar companies. They can fund their own projects. They are not putting together investment deals and bringing in investors to fund their projects. So all of these people that we're participating with, these major companies, they have almost all of the skin in the game. I mean,
Yeah.
they are the biggest holders of these wells that they're drilling. So we've got a really fantastic team of landmen and even brokers that go out and find these. So we've got a group, and let's say that there's a section of land up in, say North Dakota in the Bakken, and Continental is going to go in and drill 5 wells. Our team finds that and then finds somebody else, let's say Joe over here owns a very small 3% working interest where those wells are getting drilled. We go and meet with Joe and say, hey, we'd like to buy that working interest from you.
Hmm.
So we acquire it that way. But then there's also working interest brokers that will bring us things that, when it lands on their desk, they're like, oh, we know Courtney likes to buy these types of interests, so they'll bring them to us as well. So we've got, 30 to 50 deals that come across our desk every single week. So massive
Hmm.
amounts of deal flow and opportunity, and not just through our landmen, but through these other people. So it's not that Conoco needed us or wanted us. We bought it from somebody else that already owned us, so they don't have a choice. They have to
Right.
participate with us. And because this is such a federally regulated space, we don't have to worry about them not paying us. These interests are recorded at the county level, just like real estate is. So we go in, we buy it, we submit our information, let Conoco know that we've bought that interest, and then once they finish drilling, we get division orders and the whole 9 yards, and the rest is just history.
Yeah. And these are non-operating working interests, just so people
Correct.
understand. Yeah, we're not the ones going in there and running it. We're leaving
Right.
that for the professionals. Courtney, listen, your story is utterly fantastic. Like, I don't want to rush this slide. Would you mind, just take the microphone and share with us your story. How did you get into
Yeah.
oil and gas?
Well, it's funny, never in a million years did I think this was where I was going to land. But, I am originally from Midland, Texas, which is right smack dab in the heart of the Permian Basin. And my whole family has been involved in oil and gas my whole life. So my dad was a petroleum engineer. My brother drilled oil. My uncle has a well servicing company. My sister, even to this day, still drives an 18-wheeler that hauls water and other things out to these wells. And so, gosh, even when I was younger, we lived in Abu Dhabi and Pakistan and drilled oil over there. And then my dad drilled in Jakarta for 20 years before he retired. But back in the 70s, his good friends were, working for Chevron and Texaco and some other companies. And they would go and find oil in the Permian Basin and then sell those deals and the rights to Chevron and some of these other bigger companies. So I've actually got wells that were put together and drilled back in the 70s from those deals that are still in my portfolio producing today. And because of what he built, I got grandfathered in and inherited his oil and gas company in
Hmm.
2011 when he passed away. And it has been amazing, when I really kind of drilled in and figured out what the tax benefits are, and that, a lot of people don't have this type of access to these types of deals through the relationships that were not only built through my father, but even some that I've built out over this last several years. I was really excited. When I got into investing, I thought I was going to syndicate real estate and other assets because I was trying to diversify. But then I figured out that, there's not a lot of people bringing these types of deals to the table. And I can, and I have the access, and I've really drilled down, and we always stop and take a look at how do we do things better, how do we make this stronger, and I'm really proud of that. But it's funny, I was in the Navy, I was a nurse there for a little bit, sold real estate. I always tell everybody, I didn't know what I wanted to be when I grew up, and when I figured out that not only could I diversify my portfolio and have these massive tax savings, I was like, oh my gosh, I can do this for my family. And then it was
Hmm.
my friends. And then, I went out and set out on this mission to keep $1 billion out of the hands of the IRS. And
Yes.
I want people to, retain the money they're working for. We work so hard, and taxes are the biggest expense of our lives. And so that is my mission. That is my mission. And, as much as I want to keep people from paying taxes, I don't want you to just invest and then not get your money back. We want to get those tax benefits, but then we want to multiply that wealth. So I'm been on this wealth journey with amazing people, not, people like Walker, but also my investors, because we're all going down this same path. And I've built some incredible relationships. I'm actually making a shirt that says Walker Stalker because, I've been, downloading and listening to all of Walker's stuff because he's doing incredible things. And I think there's really great, future there too. So I'm honored to be here. I'm
Mhm.
excited. This is something that has been ingrained and entrenched in my life. We used to ride pump jacks on a Friday night after the Friday night lights football games, and I'm just excited and honored to be able to be here and to talk about this.
That's great, Courtney. Thank you so much. I want to share that um, since sort of, kind of accidentally finding myself into this new role, I just want to share that I've realized um, actually how incredibly easy it is to start a fund around oil and gas. I probably get Mike and I get probably three, um, uh, developers now working interest buyers, whatever, reaching out to us every single week. Okay. And I was like, oh man, this is like easy. Like what, why would I do this or do that or work with other people that know what they're doing? Like we can just spool this up. And the more I got into it, the more I realized it's really, really easy to make a bad decision on who you partner with. And so, the thing is like the more I hung out with you and the more I realized that, you've been running this for 14 years and your dad before you. And I started to look at, how you were sourcing deals and how you were figuring out who you were working with, like the level of just raw intelligence around how you approach what you do and discipline is really the thing that gives me such great comfort, for what it's worth. Um,
Oh, thank you for that.
yeah. Do you want to talk about Rick at all? I mean, he's the only other person on your team that I put in here. Everyone else is
Yeah, I mean
important, but
we've got a pretty substantial team, but
yeah.
Rick was somebody that I went to seek after. Unfortunately, when I got into this alternative investing space, I ended up getting connected to some really not great people,
Hmm.
people that were scammers and Ponzi schemes, and I lost a lot of money, and it was a really expensive, learning experience. And so I thought, okay, how do I do this better? And I set out on this mission. Rick wasn't looking for a partner. He wasn't looking to do anything along the lines of what I was doing and at the scale, but I found him through just months and months of research and approached him and said, "Look, this is what I want to do. Here's what I can offer you. Here's what you can offer me. Do you want to give this a shot?" And he said, "Yeah, let's do it." And come to find out, we were stationed in San Diego in the Navy at the exact same time. I was actually there during 9/11 when that happened, but he was an officer on a submarine and I was just right across the bay at North Island on an aircraft carrier. And so then, come to figure out even further, we actually live in the same town in DFW in a little town called Keller. Our kids have been going to school together since I think fifth grade, and he just has girls and I've got boys, so our paths didn't cross. And the thing that I love most about him is that he is honest. He is a straight shooter. He is not going to blow sunshine up anybody's heinies. And I really, really appreciate that. And where I am everything's going to be amazing, he's very down to earth and very grounded. And I love that about him. And anytime I've asked for anything right from the get-go, he was ready to jump off and give it to me. He had no problems with transparency. And I really appreciated that. And so when he
Hmm.
got out of the Navy, he went back to school at TCU to get his landman degree and went to work with DW. Him and his partner Martin started DW, and Martin has since passed away, unfortunately, at the beginning of the year. So we're transitioning kind of away from what they've done and into this fund model because we both really believe that this is the strongest way for people to participate in oil and gas. So he could
Hmm.
not be here with us today, but he is an incredible individual. I'm really honored to be working with him, and I'm really proud of the type of person he is as a partner because I've experienced a little bit of everything over the years.
Hmm. And he's the COO of the fund and also oversees acquisitions.
He
Okay.
does. So, yep, he is
Just
a
to bring full
landman.
circle on why we care. Yeah.
Yes, yeah, and he's outsourcing and hunting these things down, and
Mhm.
he's got a really great group of landmen that sit and underwrite these things and take a look at the offset and do the due diligence and make sure that our legal and title and everything is done correctly, and that he handles all of that, asset management and acquisitions in the background.
So I'm going to talk for just a second about due diligence. Then I'm going to hand it to you, Courtney, about how you do due diligence on the acquisitions. And what I want to share is a little bit of a story in that, listen, I number one, I did elaborate diligence on this fund before I brought it out, but I did it myself. Okay, and I looked at a number of prior funds and their performance and background checks and all of the sort of like standard kind of diligence things that you do. And Courtney, knowing that we were going to bring millions of dollars to the table, gave me red carpet access to everything. Um, as you guys know, I typically bring in a third party as well. There's sort of two things that held me back from that. Number one, I am an investor already in Courtney's prior fund. I know Courtney personally, and that's great. But like let's do diligence. But the thing is like number one, this is a fund. We'll talk about what's been acquired already. But the thing is this is a fund that's going out to acquire. So it's not like there's a bunch of existing assets. So I'm really underwriting the team and what they've done, and I felt like I was able to do that with a level of competency with what I've been provided. And everything's documented. All acquisitions that they made are documented. Everything is great. Their investor communication is wonderful. All the rest of it. Um, but number two, I talked with two separate parties. One was a very large investor, actually hired a geologist with decades in the oil and gas industry and hired that person to come on and continually run ongoing diligence. Well, I know that investor rather well. We're friends. And again, big numbers, like, whatever. And so I talked with, he's like, look, you can hire my guy if you want. And I talked to him, and he was going to cost our fund an additional 20 plus $1,000 per month, just to stay on and keep tabs on what's happening. And, that's not an expense I felt we needed given how the level of diligence that Courtney's doing on her acquisitions to begin with. But also it felt like a way that I could like do a third party stamp on what we're doing, but it didn't really seem like it was worth the squeeze. Second, there is a group of five medical doctors that, all write seven-figure checks in the private markets. And I know them, and they essentially have a notorious difficult due diligence process where they just like come in with an economist and their team, and they just run things deep into the rabbit holes. And Courtney was a victim and a beneficiary of the process and the resulting thumbs up of the process, as well as the geologist. So I talked with both of them a couple of times and sort of ultimately said, like, you know what, I'm doing enough diligence here. Like Courtney's giving me enough access. I've been invested in the prior fund. And now that I'm talking with two different diligence teams that have just run her through the ringer and come out with the thumbs up green light, I would be giving them our money as investors in our fund for no other reason than to tell you guys that I did. It felt very, very competent. And again, the big point is that this is a fund where, 8 assets have been acquired, but we're hoping to go out and buy, 42 to 90 more, right? So, Courtney, do you want to talk for a few minutes about the kind of diligence that you guys are doing before you're doing acquisitions on new assets, and then we can go into the Colorado 8 that you've closed on already in the fund.
Yeah, and this is all really great. Obviously if Continental or ConocoPhillips is going to drill, I don't have to do background checks. I don't There's a lot of those things that I don't have to underwrite. So when we're taking a look at what they've already done, like I said, they are the primary majority holders in these deals, in
Hmm.
these wells. And so I know they've done their homework, and because they have almost all the skin in the game, they're going to run these, and they're going to squeeze every drop out of these wells that they possibly can. And we're just kind of riding their coattails and reaping the benefits of it
Hmm.
because they are footing the majority of the cost and everything else. And so they're not doing stuff to help their investors out. They're doing it for themselves. And so I think that's really important to understand. So what we do is take a look, we've got to go in and look at the acquisition costs, and this very first area on the left, this activity, we take a look at, what we're expecting these wells to do, and then we take a look at all of the other wells in the surrounding area, which is called offset production. And we want to figure out, is what we think these wells are going to do typical for that area? How have these other wells performed? What was the high? What was the low? What was the average? And, is it in line with what we're expecting these wells to do? What is that depletion rate, which kind of goes into that forecast review? What do we expect that to do? What do we expect the returns to be? That comes into that lateral length. And I will tell you, this comes into play in that vertical versus horizontal drilling. Vertical wells, typically, if you hear the horror stories about people go in, they invest in a project, it was one well, it was vertical, which means it was just up and down. The hole was dry, there was no oil, they got the tax benefits and lost their money. Well,
Mm-hmm.
we are only participating in horizontal wells. So that means we go down typically a couple miles, and then we typically go out, 2, 3, 4, 5 miles sideways, which is our lateral length. So we take a look at what that is. Now, it is more expensive to drill sideways like that, but the recovery rates are 2 to 7 times more, and the success rate is over 90%. And so we have not had a dry well. We have had oil in every single one of ours. And in fact, Rick and I combined have participated in over 1,200 wells, and the number of wells that either did not produce or did not have oil is 10 out of more than 1,200. So it is, and it was not anywhere near this last several years. And so the success rate is very, very high. But also, if we've got one, because we will have wells that don't produce as much as we expect, it doesn't matter how good or whether you're Exxon and the number one producer in America or the 48,000, smallest producer, we're all susceptible to the price of oil and how the wells produce when they come online. So the more diversification we have, the better. Low break even numbers, but we take a look at all of this, and that's where that sensitivity analysis comes in. We take a look at what is the price of oil doing, how much do we expect these wells to produce in their lifetime, and then how much do we expect them to produce in year one, year two, year three, and we come in and we create this chart that imports all of that information and then spits us out some numbers, and then we can go in and change it around and see what it looks like at different levels. And
Mm-hmm.
so it's there's a lot that goes into it, but we're pretty confident in what we build as well.
Mm-hmm. Plus, everyone that you're buying from has such extensive histories in the space. Yeah.
Absolutely. These
Yeah.
are not people that are new. These are people that have drilled, 1,000 plus wells. Some of these have drilled 30,000 plus wells.
Mm-hmm.
These are significant companies with massive amounts of experience. And so this first package, and actually we've been buying stuff all year long because of the low oil prices. We have been buying and snapping up assets all year long. Now that, here a couple weeks ago, we started having funds actually coming in, we are starting to sit down and take a look at, okay, what else are we buying? Where are we going to allocate? But we have bought significant things with Continental Resources, Coda. We bought stuff up in the Bakken, the Niobrara, and the Anadarko basins already with a lot of major producers. So we are excited about that. This Colorado package is with a company called Fulcrum. And the great thing about oil and gas that's a little bit different than real estate and other things is we have so much flexibility. And when we bought these wells several months ago, it was 8 wells, and they're drilling all 8 wells. Well, they've decided that here just within the last week and a half, they're going to delay drilling 4 of them. They've already started drilling the 4. They're expected to be online and producing this month. But the beautiful thing about this is we said, okay, we're going to skip participating in the second 4, and we're going to reallocate that money to something else because we know that they're going to drill them, but is that going to be in a month, or is that going to be in 6 months or 6 years? And, having assets when we don't know what the timeline is does not align with what we're doing. Our goal is to go in, acquire assets that have either started being drilled or they're about to start. And if it doesn't meet that, then we want to move on to something else. So, fortunately, because of the flexibility we have, we can reallocate that money to something else, and we're going to do that. But the beautiful thing about this, we've got an 8.5% working interest at this point in time in all 8 of those wells. They have already started drilling, and they're expecting them to be online this month, at least those first 4.
Mm-hmm.
Now, we are in their last four wells, and I've got the offset data beforehand from the previous project. And these wells are expected to produce anywhere from about 600,000, or actually, I think the low number was 650,000 barrels in up to, I'm sorry, 1.3 million. So we have got substantial, numbers for these wells and what has gone on in that area. And our project, when we underwrote these numbers, we underwrote all of it at 650, 675. And so we've really got a lot of potential upside in there, for what these wells can actually do. And our break even price for this project, I believe, is right at $37. Everybody we participate with, the max is going to be $40.
Yeah.
That is a hard
Yeah.
asset underwriting, criteria right there.
Yeah.
So.
And not to look, I don't want to go down this rabbit hole, but like if oil's at $35, like someone's going to start a war. Just saying.
Oh,
I'll just
and
I'll float that out there. Like
well,
oil's
and if
going
you
up.
take a look at the times where oil has dropped below $40 over the last, I mean, you can pull up several decades. It doesn't stay long. I mean, it,
Right.
it drops, it hits it, and it goes right back up.
So I want to dive right into the fee structure so that everyone understands. So let's say, for example, this is a sample $100,000 investment. The Iron Horse management fee is 6% at this level, and then there's an Iron Horse contingency at 5%, and our Build Energy acquisition fee is 2%. Okay. Now again, once you add all of these up, okay, you see that 87,000 out of the 100 is being deployed in actual wells. I want to be very clear and tell you that if you go direct and invest $1 million directly into the fund, your fees will be higher than this. Okay. So like the thing is that this is discounted, but when we are looking at returns, when we are looking at the multiple that is coming back to you, as well as the tax write-off, it's all being pegged to that $100,000 investment. These fees are only to be completely transparent with what's happening. Okay. Now, on the lower left-hand side, I think is the more important aspect, which is that there's essentially an 85-15 split. 85% goes to the LPs in Build Energy II, and 15% goes to Iron Horse and Build Energy II. So the GPs of the funds. Okay, so it's a 85-15 split. This is all of the fees. There's no ongoing fees. One of the things that we do at Build Wealth, there's never any operating expenses. All operating expenses of the fund come out of our fees. So all diligence that was done, all legal, and all staff are paid just out of the fees that we make. So again, the majority of the money that I make on all of these is with my own investment alongside you guys. Okay. I want to jump into what a sample 100,000 might look like. So is that what I wrote here? So basically what we have is, I'm not going to spend a lot of time on this slide. A lot of this is going to be in the data room. You guys can, stare at it all you want. What I did was, look, as I was going through all of this, I mean, I ran the numbers 85 different ways, guys. And at one point, I just texted Courtney and I was like, okay, so basically, we don't really know what's going to happen at all. We're just sort of like doing the things we know lead to the outcomes. And historically, the averages, all kind of support what it is that we're doing. And so the thing is like if oil prices stay low for an extended period of time, sure, it might take 4 years for us to break even. If they, pop back up, we'll be whole in two, like all these kinds of things. So the big variables are what is the price of oil and what is the output of the wells that we're acquiring. Okay, just even if you just get it down to those two things and realize that the volatility impact of both of those is big, that's what dictates the outcome of what it is that we're doing. The bottom line is that you are saving on tax dollars and then rolling those tax dollars and multiplying them, as well as the investment that you're making. That's the goal. And, that's the thing. And of course, there's all these other risks, but the risks have to do mostly with the standard deviation allotted towards, or the sensitivity analysis towards like, what is the price of oil for what period of time? And the fact that oil is going to stay a fixed price for 5 to 10 years is zero. That's never happened before. Okay. So how are you going to underwrite it? What Courtney has done, and what I support is jumping in with a 72% oil price, because that is the average over 10 years, and we believe that that will be the average for the next 10 years. Okay, depending on how long it takes to get there, no one's going to know. And so that's what the base case is built out of. But there's also assumed to be very low production. 650,000. And so the thing is even the Colorado 8 is already out producing those numbers. Okay, so we're conservative as much as we can, but we're also like being fair as much as we can. Courtney has examples where people already have a 400% return on their money, just because of the timing of the fluctuations. Okay, so this is where the risks are. At the end of the day, if you want to not pay taxes and make those dollars multiply, this is that investment. And so you can see here, I'll just jump to the internal rates of return as an example. With just cash, okay, on a base case, you're looking at almost a 1 point, well, you got a 1.82 equity multiple with an internal rate of return of 21%. And then once you include the money that you get to keep and not pay Uncle Sam, you're looking at a 33.7% internal rate of return. I'll let you decide how you want to tell time. And the thing is I will tell you that as I went and stress tested all of the models, even when I stress tested down the price of oil and the production and looked at it, if you count those dollars that you're not paying in taxes, you're basically made whole in 24 months. It's just that you own an oil well now, okay, rather than paying taxes. And so there's one way to think about it. I love being a rational human being because I can rationalize anything I want. And so the point of this slide was to break down, some projections by year. Again, I'll let you kind of stare at this on your own time rather than all of us here together. But, you'll see that, in year one, there's like 54%. Then it drops to, 54,000. Then in year two, it's 27,000. Year three is 16, then 8, then 5, then 4. The point is that I really want you to understand that these things will cash flow for 20 years or so unless we sell it. Right. And we might sell it as long as there's not a taxable event. That's ultimately up to Courtney. But the point is that like you get a bunch of your money, you save on taxes, you get your money back as fast as possible because that's when the wells are producing as more than later. And then you just kind of have this long tail where all of a sudden you made an investment, whatever, 5 years ago, you've had all your money back, you didn't pay taxes, and you're still making, $4,000, $5,000, $6,000 a year, right? Just coming through in monthly payments, which I would classify in the awesome category. So that's the big takeaway that I want you guys to figure out. And also, you'll see the equity multiples at the bottom, jumping between a 1.1 and a 2.5. And this is just the cash flow from the wells. It does not include the infill drilling. It does not include. Oh, it does include an exit multiple, doesn't it? On this or no? Wait,
It does not, and it
no,
doesn't, that contingency money that you talked about, which we should talk about that a little
we
bit
should.
more.
You're right.
It doesn't include that. It doesn't include other wells that we'll sell and things
Great.
like that.
Great. Um, that is a good point. Can we talk? I'm sorry that I skipped over that. Can we talk about that contingency? Because it's actually extremely important.
It is, and it's something, I've had several financial advisors that I've been working with, and they're like, this is one of my favorite things. I've never seen a fund have a contingency in place. And, one of my investors actually told me he's invested in 7 deals, and this year, my 2 of them are with me and 5 are not. And he actually works for an oil and gas company out of Houston. And he said, your 2 deals are the only ones that are paying. And not only are the other 5 not paying, I'm actually having to contribute to the monthly operating expenses. Because regardless of what the price of oil matters, and this is why that break-even price matters so much, you've got monthly expenses to keep those wells online and going every month, regardless of the price. And they have to be paid. And so we have a contingency fund so that if oil prices drop and stay there, we can come out and we can cover that through our contingency fund without having to come back and ask investors to contribute more money. We never want to come back and have you write a dollar more than your original investment ever. And Rick, since he started in 2008, and between us, more than 175 deals have never had a capital call ever. And so the other thing too is because we do own these interests, there can be liabilities, and we do opt into the operator's insurance. But this is also another reason why we only want to own a small interest in each one of these wells. Where most people own 100% of whatever the deal is, we come in with small percentages. And I want to give some perspective to that, because at this large of a fund, when you have to plug a well, it's expensive. It's like $100,000 to plug a well. But when you break that down on $100,000, and let's say we own a 5% interest in a well, we have to plug that. if we didn't have the money to cover it from our monthly income, we could go in and get the money from the contingency fee. But on $100,000, since we have a 5% interest, our portion of that is $5,000. And I think when
Mm-hmm.
you
Mm-hmm.
translate that down to the individual investor level on 100,000, I think it's like $5. I mean, it's very, very small compared to what you're looking at for the whole total amount. And then, I always get asked the question, what if there is some crazy kind of lawsuit? And we always opt into the operator's insurance. And I will tell you, Exxon and ConocoPhillips, these companies maintain massive amounts of insurance. They have deep pockets. And if something negligent happens, first of all, I have never even been able to find a lawsuit where a non-op working interest owner was held liable for damages that the operating company did. I can't find one. I personally do not, maintain any other additional insurance outside of what the operators have. But just to give you even some perspective there, because it really does matter. Let's say there was a $10 million award above and beyond what insurance covered. And uh, if we had a 5% interest, that means that what is that, $500,000 would be our
Mm-hmm.
portion of that. And if you trickle that down to the $100,000 investor, that would translate to about $500. But fortunately, because of our 5% contingency fund, we would actually be able to cover that with our fund. And that fund is going to sit in a 4.5% interest earning money market account. And I'm actually working with the financial advisors at Truist to see how we can incorporate, how we can kind of ladder out some different treasuries and things like that, to really kind of beef up those returns and get that going even more. So anything that we don't use of that contingency during this fund, along with the interest, will get returned back to investors at the end of the deal.
Thank you so much for making me go back to this because I skipped over that, but it's really not a fee at all.
Right.
It's really protection that we're it's actually one of the reasons why I love this fund. And even when I was talking with the attorneys that set it up, they're like, "Do you want to keep a contingency?" And I was like, "I don't think so." And that triggered me to call you, and we had an ongoing talk about how much protection is going there. And I just and I think a lot of times people look at fees and they're like, "Oh gosh, I don't want fees." And all I'm going to say to that is it takes a lot of money to run a team in order to do this. Okay. And so the 2% acquisition fee at Build Energy, I will just tell you guys, I'll share like totally transparent. There is approaching 0% chance any of those dollars are profits at all. It's either out of pocket paying for the team or we'll pay for overhead next month and then it'll run out. Like that's it. Like this is not a money making fee structure. The contingency is for our support and confidence to know that the fund is going to operate. And a 6% fee, if you think about it, that's $6 million to run a $100 million fund with the team, the acquisitions, the legal, the diligence, the overhead. It's like we literally are giving, 10,000 or sorry, $6,000 of 100,000 in overhead for the team to go get the best deals for us. And that's what it's for.
And I'm glad you brought that up. It was
Yeah.
asked to me last night. And, I wish it was oh, I'm taking 10% and putting it in my pocket. And
No,
that's just not the case. Like,
no.
I've been building this and we've been working on this for eight
Yeah.
months. 8 months. And we have millions of dollars deployed into this already before we ever even brought it to the table. And I mean, we have a 5-person, in-house accounting team that manages all this. Oil and gas accounting there's a lot that goes into it. Our
Mhm.
reports are very detailed, and we have legal and title and landmen costs and everything. So really, we've been footing the bill for all of these acquisitions and our landmen and everything else for 8 months. So a lot of this will kind of actually go to repay what we have already gone. And so really the money that gets made or the benefit comes from the production. So we are very aligned with our investors in that if we want to start making money, we need to make sure that we're sourcing good projects with good operators that are going to be successful.
That's right. Um, do you, look, I think we can skip over this slide. It's essentially like you can offset any income with these tax advantages. Of course, the big one is any W-2 or active income that you're getting. Courtney, do you want to do the honors and just kind of talk about this briefly? I think, you know what, can we jump straight to depletion allowance? Because that's another thing that I forgot to mention, which is as you're looking at these, annual payments, cash flow back to you, 15% of that amount comes to you completely tax-free, right? So
Correct.
that first year, 54%, or sorry, $54,000, 15% of that is tax-free to you. And so the cash flow also is very tax advantaged. Just want to harp on that.
Yeah,
Go ahead.
yeah, and we'll talk about those. Those IDCs are that first one. Those IDCs are what give you that active benefit that's going to reduce your
Yep.
W-2 income. That's what everybody loves. Fortunately, you get 100% of that write-off the year you invest. And for those that are wondering, you will get all of that for 2025. We will deploy all of the capital this year. We will deploy it before December 31st, and you will get that tax benefit this year. But the IDCs are things like fuel and labor that don't have any kind of value later on that can be sold like equipment. So you get
Mhm.
it in year one, and then the depletion allowance is that ongoing 15%. The depreciation recapture is also very important. When we have depleted, 80, 90% of the oil in these wells, and we've already 2x'd, hopefully oil prices went up and we 3x'd our money. When we've gotten to that point where we've trickled down, nobody wants to deal with $1,000 or $5,000 a year K1 when we've depleted the majority of that. So we can exit, but we want to make sure that we exit at or below our cost basis. So
Mhm.
let's say it's a $100 million fund. We got an 85% K1 loss in year one. That makes our cost basis $15 million. So we need to exit at or below that. And we do that by making sure that we've depleted the majority of the oil and then we exit. So we will not do anything that's going to cause some sort of depletion recapture event unless there is some massive income benefit to it. If we come in and figure out that one of our leases has massive amounts of oil and we're getting, $500 million offers to purchase what we've got, then yes, we will exit at that point in time. But, it's got to economically make sense. And the benefit has to outweigh that recapture in order for us to do something like that.
Yep. Now, if investors are new um, to this style of investment, they might not understand that they're coming into BuildEnergy II as general partners and not limited partners, which is slightly different. Usually, there's a GP that is, saying this like the sponsor, like myself, for example, or Courtney, and we're the GPs of our respective funds, and the LPs are the passive investors that have no limited liability, is what it is. So they have no liability in terms of the operations. For example, some of you are in the Build Legacy Fund. I have a whatever 3.7 million personally guaranteed liability on that fund, as an example. You own nothing. You just get the upside. And the downside of whatever investment you put in. So this requires a GP investment in order for you to get the active losses. So everyone coming in as a GP, and want you to understand that. And so there is ways that this risk is, sorry, it's unlimited liability exposure to all of these rigs. But Courtney, do you want to speak for a little bit about
Yeah, and
how
this
the
is
risk is mitigated and
sure. We talked about that contingency fund and the
yeah.
the insurance and the interest ownership in the well. All of those things are very strategic and why we have them in place. But the tax code says that you have to have unlimited liability to be able to get those active benefits. And so our deals are structured as limited partnerships. You come in as a GP. Once all of the drilling is definitely and fully finished and complete, we can convert you. And we do that at the beginning of each year. And so this will most likely happen January 1st, 2027. And I want to also share that the that unlimited liability in the tax code doesn't necessarily translate to unlimited liability in the legal space. It's a little bit different. So, I get a lot of people that are very concerned about all of their assets being, losing everything to something that's happened in the oil and gas space. But because
Hmm.
of the insurance and the contingency and our max interest ownership, it really does limit the amount of that liability. And then, like I said, it will just be for about a year.
Yeah. And then transitioning GPs to LPs early 2027.
Yep,
That sounds right.
January 1st,
Okay.
2027 is when I expect that to take place.
All right, great. Listen, if you are ready to move forward, we have two things to do. Jump into our portal at buildwealth.investnext.com. You can see our landing page to soft commit. I wanted to have this ready to go by noon today, but the legal docs are taking an extra turn. I do want to make sure we get a model up for you guys. There's a lot of things in the portal already for you to look at. If you're like, I know this is, likely for me, or I want to get going, or just hold my place in line, hit that soft commit and sign up. Or reach out to Mike Brown. Mike Brown's our director of investor relations. This is his cell phone number. You can text him right now. He's on this call. And so this is his email. This is his cell phone. He's on standby, waiting for you to have conversations with him. Now, some of you are going to say, "Is this right for me? Is it whatever?" Talk to Mike. This is part of what we do. We have a lot of different investments available, and we want to make sure that you're comfortable with everything that we're doing. Courtney, we have some questions. Do you have a few minutes
Yeah,
to do
let's hit
that?
the questions because I
Okay.
was just looking at them. There's some good ones.
All right. Commodity price fluctuations also play a part in the returns.
And that's
Yes, they
exactly
do.
right.
Yes, they do. I
Yes.
think I think we covered that. There's a big variation there.
I
Uh,
think David is saying, "Hey, the price fluctuations are what is giving us, that gap." So I think he was kind of
it's
confirming that.
yeah, it's also yeah, it's the buy low, sell high thing. Oil's low, that's when you buy whatever. Okay. Is there concern that there is oversupply and that this will drive down the price per barrel down to $50 to $60 per barrel? What are your thoughts?
I think this is back in that, we've got to zoom out and look at the bigger picture. I think we're going to chop around in this $60 to $65 range for just a little bit, but at the
Mhm.
end of the day, we are not we are not exploring and drilling to keep up with demand, and there's going to be this gap. And I have a feeling that when y'all have your Aspen Fund deal, Bob does such a fantastic job of really getting into the economics of this. I think you can't really focus on what's happening right now and just know that this is a really good acquisition time. We're getting really good tax benefits, but I expect this to change over the next year or two. I really do.
Mhm.
Unfortunately, while it's chopping around in this, we're going to be drilling. And then hopefully by the time everything's online, we'll start seeing some higher numbers.
Mhm. I think, the other game here, guys, is I always look at the North Star, and the North Star here is I'm going to make an investment instead of paying my taxes this year, or minimize, whatever. And in addition, I'm going to multiply that investment. Okay, so that's the bottom line. And if you are of the mind that oil is going to drop down to 35 or $40, what I would say to that is that's we are buying at places where that's the break even number. So we're buying and in wells where they're still able to operate without shutting its doors at that kind of number. And what do? They hoard supply, right? So it will take us longer to recoup. But ultimately, I mean, Courtney, what do I say here? No one's the odds that we're going to get a 2x or more on our money are very good with a very high confidence level. Again, back to that disclaimer language, but like that's what we think, or else I wouldn't be taking this out. This isn't like a
And
comment.
same. And
Yeah.
these oil companies, ConocoPhillips and Continental, we've bought a lot of stuff with them this year. If they didn't think that they were able to make money, they would not be out there drilling. It
That's
just
right.
wouldn't be happening.
That's right. Patrick, does Build Energy One offer the same tax incentives? Why choose two over one, which looks okay? So yes, both Build Energy One and Build Energy Two are both open. Number one, probably the most important thing I forgot to say is we have a hard close on this fund at the end of November. You've got to get your funds in by the end of November, or else it's got to close. And the reason is because of the tax benefits and just because of all of the processing. And like so that's what's happening. So we have like 1 month for Build Energy 2. Build Energy 1 is a same asset class, completely different strategy. Again, reach out to Mike, but Build Energy 2 is all about the tax incentive, which Build Energy 1 does not have. Okay, this is the save money on taxes and multiply that money. There you go. Kishore, good to see you. If the oil companies knew well in advance where they plan to drill, wouldn't have sent it in their own teams to acquire the land. Oh,
Well, and
You want
just
to take
because
this?
there's a
Yeah.
project out there doesn't mean that there is a portion that we can purchase. Maybe they get 100% of it, but
Yeah.
a lot of times, a lot of these projects are drilled on federal land. And what the government will do is at some point in time, they put those mineral rights up for sale, and people go in and they snatch them up as fast as they can. And a lot of people will just sit and hold it. And because it's like real estate, when the land is raw, it's worth, $250 an acre. Once, there's permits to go in and start building, that price goes up. Once drilling starts happening, that price goes up. And so it goes more and more. So, like one of our recent projects where that raw land was probably, and those interests were sold at 250 an acre, we paid 7,500 an acre for it. And we were willing to pay more for it because they had already started drilling. We knew that they had already confirmed that they had commercially producible oil in those wells. And so I am willing to give up a big portion of that upside to know that we're going into a strong project. We've got oil, we've got the good tax benefits, and I'm willing to give up some of that upside to have that confidence in what we're participating in. And here's the thing, and the other question people ask is, well, why didn't Continental just go in and buy up that other 3%? And it's because I'm willing to pay more for it. They wanted to pay 250 an acre, and now it's worth 7,500, and I'm willing to pay that, and they're not.
Got it. Yeah, and the other component of that I think is sort of just capital allocation. This is maybe a little bit of a speculative, flippant comment. I don't mean it to be. It's just sort of like, kind of there's a business fundamental where it's just kind of like, if you are trying to look, like drilling is very capital intensive. And so if I'm already deploying, pick how much does it cost to build one of these pump jacks?
Well, I can tell you it's about 10 to 12 million dollars to drill a well.
Okay, so I buy some land and I'm an operator, and so I'm gonna go out and invest $100 million of my own money to drill, 9 different wells or whatever. I'm not necessarily wanting to go out and increase my risk exposure by making sure I'm buying up all of the non-working interest properties because the whole business model makes sense with all of those already in place. And so a lot of it is like, I'm going to drill these and I'm going to make sure they're extracting oil, but I want to make sure that I'm not just drilling these 9, I also want to drill these other 1,000 this year. And so there's just a lot of like,
And
it's all
you're
about,
exactly right.
yeah, it's
Having
how
some
much
other
volume.
smaller interest owners frees up some of their capital to
Right.
deploy it into other projects.
That's
Yes.
right. It's just like anything. It's like any startup entrepreneur who like could use a little capital, even though they have money in it, but like, sort of a bigger version of it. You don't have to resonate with that. It's just, once I understood that, it made a lot of sense to me. Can you clarify if our invested capital will be deployed in 2025?
Yes, it will.
Yes. Constantine, good to see you. Would it be possible to explain a bit more about how you get at access to these deals? Why don't the brokers go to Conoco, and why doesn't Conoco have land people to find these investors first?
I,
Thank you.
I think we just talked about
I
all of
think
that.
so too. Yeah. Constantine, thanks for being here. I appreciate you, brother. I joined late. Will there be a recording? Yes, of course. In your sensitivity analysis, was it considered if the price goes down by 20% current levels in case there's recession due to multiple factors? And what was your findings? Okay. So, comment here is all of life is risk, all of investing is risk. This is one of these where, we're taking an investment thesis that we believe that oil is low. We believe that this is a 5 to 10 year fund. We believe that the average price of oil is $72, and we are doing as much as we can, like building a contingency, buying land in places where operators have a low break even, and essentially, again, just coming back to, if you make an investment, if 9/11, the tech bust, and COVID all happen in the same month, we're all screwed, and this investment will be also be terrible.
Well, the great thing is we won't lose it because we own it. We do have a
Yeah,
contingency fund, so
yeah,
we can withstand a lot. Where a
yeah,
lot of other people are going under, we're able to withstand that and still come out on the other side. I mean, are we going to have to, weather some either low or no payments if that happens?
yep,
Absolutely. But guess what?
absolutely.
Nobody's taken our asset from us, and
That's right.
and we will come out. It will flip eventually.
That's right. Agreed. So, I mean, this is an anonymous attendee, so I can't call you out by name. I think it's just one of these where there's a standard deviation of prices. The sensitivity analysis, I went down to in my own side, I went down to in the 50s. I can't remember exactly what I showed you. I apologize for that. But what I would
Yeah, and
say
I think
is,
it's like if you go down and if it was $54, I think was the lowest I
Mhm.
priced it out. I think it ends up being like a 1.2 or 1.3. I mean, it's much lower numbers. And is it exciting? No, it's definitely not. But I'm
Yeah,
also, confident that, we are going to produce oil. We're going to get those tax benefits and money's going to flow and come back. I just can't guarantee you what the price of oil is going to do.
yeah. And so if you're not paying taxes and you're getting a 120% return, then it's still an up. What I would say is actually to this question, I would say the opposite. I would say that on the high end, um, the 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 sensitivity analysis was extremely conservative. And what I mean by that is that Courtney has a number of funds and portfolios that have significantly outperformed the best case column in there as well. So, I think all of it was, sure, I didn't, bomb it out to zeros on the sensitivity analysis, but I also didn't, what I would say is there's a higher confidence level that it would lean to the higher end than the lower end based on the numbers there. And it's really important to me that I'm not showing you guys numbers that are absolutely crazy that we're not going to hit, right? So I think that's just
Absolutely.
that's just our responsibility, right? Exactly. Can you send me this deck? Yes, it will be in the portal. It seems to me that I would have to explain these tax advantages to my accountant. Is that the case that I will need to be more informed than my accountant?
Um, and I will tell you, I always end up with one CPA every deal that tells their investors or their clients that you can't use working interest to offset active income. And I will tell you that's absolutely just not correct. And
Mhm,
I would really even say, and please don't take this wrong, I don't mean it in an ugly way, but
mhm,
if you're making those types of investments and utilizing these types of strategies and your CPA is not aware of them, because this has been around for decades,
mhm.
you probably have outgrown your CPA at this point in time.
Yeah, I think it's also, it's also what I learned the hard way was, when I was paying more in taxes than I was earning in income for 3 years in a row. I ended up finding that, I mean, there were partners at, regional CPA firms that told me like, oh, we don't know anything about tax strategy. And so I ultimately went out and got a tax strategist. Happy, and I left the first one and found another one. I'm so happy to make an intro if that's interesting. And of course, what's great is he's like, listen, I've got this oil and gas deal, and I looked at it, and it wasn't as good as ours. So I tried to sell him our Build Energy 2 fund, Courtney. So that's just one example. Thank you for the question. And it's also one of those questions where, um, um, I'll just leave it at that. It's sort of like whenever anyone says like, should I hire a lawyer? The answer is always 100% yes. You cannot answer any other way. So if you're saying, do I need to educate this and have a conversation with my CPA? There's no other answer than yes, you need to, right? But like that's up to you and how you choose to run it. But yeah, tax strategist has saved me lots of money and time. You're running behind time. How will you deploy 85? This is the question. How will you deploy $85 million in less than 8 weeks? Is there a chance to deploy any funds for not fully vetted funds?
Absolutely not. Our underwriting criteria is very strict, and these assets either meet that criteria or we're not going to participate. And I also invest in these, and we usually take very big chunks ourselves because I also need the tax benefits. We usually take anywhere from 5 to 10% in every one of the deals. Obviously, I can't take 10% of this deal. I don't have $10 million to deploy into this. But I will be a big participator. But we have been buying stuff all year long. We have bought stuff with Continental Resources in Oklahoma. We've got stuff with Coda up in the Bakken. I mean, we have been buying stuff all year. So we will continue to look at what else is coming online. We actually just purchased a couple more wells with another big company in Oklahoma. So it's not that we haven't been buying stuff. We were kind of waiting more along the lines of to see, we had $112 million in soft commits for this fund right after we launched. Now, how much money does that actually translate into the fund? So before we start allocating and going, okay, we're going to buy all of this and all of this, we want to make sure that we are creating that diversification that we're looking for before we start allocating more assets to it. So if we end up with 50 million instead of 100, instead of buying entire projects that are out there, maybe we buy 50% of it because we have that flexibility. And if we end up with $150 million, well, then we'll buy, bigger portions of projects or, whatever that looks like. But we have the flexibility and it will not be a problem.
Yep. Thank you. Is there any way to protect from unlimited liability counterinsurance that can be bought at the fund level? I think we answered that. Would you agree?
We do.
Anything else? Yeah. You agree? We answered it.
Mhm.
Yeah. How
And
does
if
the
you want to go get your own personal unlimited liab umbrella policy, you definitely
sure.
can do that as well.
Yeah. How does the tax offset work? Is it dollar for each invested dollar that offsets income?
That's a great question. Now,
No.
it's tied into those IDCs, which when we say 80 to 90%, we're saying that 80 to 90% of the funds are going to be allocated towards those IDCs. And so when we start looking at assets, they'll give us the drilling bill. Let's say they're planning on it being $10 million. We will not buy anything that's 20%. The purchase price is 20% more than 20% of the AFEs to drill that well, which means in this case, if it's $10 million, we're not going to purchase anything that is, what is that? $2 million? I guess 2 million is 10,
Mm-hmm.
1 million, whatever that number comes
Mm-hmm.
out to. And
Mm-hmm.
actually, because of the lower oil prices, we've been acquiring stuff at the 12% range. So it's been significantly less, which is why we have those higher numbers. And because of the variation in the those initial fees and things like that, it allows us, better numbers. And like those Colorado wells, because of the purchase price of that one's actually going to spit off about 92% in K1 loss. We're not quoting more than 90 because, there might be some things we buy that land us around 82 or, because we haven't finished buying everything. I think between 80 and 90 is a really good place. And really 85 is probably a really good number to land on.
Mm-hmm. So let's take it to the LP level, just so that we can clarify. So someone invests $100,000 into Build Energy 2.
Mhm.
We take that $100,000 and it reduces their earned income by
Well, you will get a
approximately.
K1 loss for 2025 that has somewhere in that $85,000 range of a K1 loss. That is
Right.
good to reduce your taxable income. So let's say you make $500,000 this year, it will reduce your taxable income from 500,000 down to 415,000.
Excellent. Thanks for being so clear. Um, okay. I think that's all. Let me just check the chat. And great. Okay. So, uh, Courtney, listen, in closing, thank you so much. Thank you so much for starting this fund. I've sort of been standing next to you the whole time that you've been working on it, and it's just been such a pleasure to get to know you. And I'm really thankful for this opportunity. Thanks for letting us start Build Energy 2. Thanks for your partnership, and I'm really looking forward to working with you.
Same. The honor is all of mine.
All
Walker
right, guys.
Stalker.
You can get your free Walker Stalker t-shirt for investments of 250,000. Listen, thanks everybody for being here. We're a little over time. Reach out to Mike Brown, get those calls scheduled, get those soft commits. We've got a hard close at the end of the month. And if you want to dive into all of the other investments and figure out which one's right for you, that's why we're here. Thanks so much, and we'll see you on the inside. Thanks, Courtney.
Thanks.